From Barangaroo Studios, the ausbiz COB is the key stuff you need to know about the day in business and finance.
Hello, welcome to the COB. I'm Juliet Sarley on this day where we've really kind of struggled for direction, similar to what we saw, of course, on US markets overnight. Let's have a look at where the CBO 200 is finishing the day's trade. It sort of started pretty flat, didn't really move too much along, and we've closed just 2 points high there on the CBO 200. Having a quick look at where the ASX 200 is, it was up by around 13 points on the close. Still, of course, match out happening, but 0.2 of 1%, 7,826. Now, it really was, as we said, a day of kind of treading water as we await this key inflation data out of the US this week. We've got PPI tonight. We've also got our own jobs report coming through later in the week, another key piece of the puzzle for the RBA. But when it came to wages growth, the wage price index for the second quarter, a bit of a snail's pace there. In fact, the slowest growth in terms of wages in a year. It was interesting with the private sector, it rose by 0.7 of 1% in the quarter. That's the lowest for a June quarter since 2021. Oxford Economics saying the RBA will be relieved. Other economists saying that the wage growth is still elevated above 4.1% on an annual rate, and that of course that means rate cuts are a long way off. In terms of cuts though, are we going to get one from the RBNZ tomorrow? One Kiwi economist we were talking to telling us that it is the most significant interest rate meeting that the RBNZ has faced in a number of years. So of course some forecast that they could actually start to cut as they start to see a lot of signs of weakness in their economy. A quick look at what we saw in terms of sectors today, and CSL really dragged down the overall healthcare sector, down 4.7% its share price. And of course, when you are one of the priciest stocks on the market and such a big weighting, then that did weigh on the overall healthcare sector as well. Cochlear pretty flat. A quick look at where the telcos finished today. Telstra up by about a third of 1%. TPG Telecom had a good day. Looking at the banks, they all looked pretty good. Of course, CBA reporting tomorrow, $132.31. Koshi's going to be speaking to Matt Common. Be really interesting to get his take on what they're seeing potentially in terms of mortgage arrears or defaults, as well as we start to see these high interest rates really impact the economy, and a lot of people that were on those fixed rates roll off into variable. And when it comes to the miners today, we had BHP Rio tracking higher. Also worth noting, the gold stocks were a really bright spot today because you've got that gold price above $2,500 on these expectations of aggressive Fed cuts. And the energy sector was also a real standout today. That's as oil prices continue to rise amid the conflicts in the Middle East. A quick look at what we're seeing in terms of corporate stories. We mentioned CSL. It forecast annual double-digit earnings growth for the next 5 years, but its vaccine and pharmaceutical operations, it says, will slow revenue gains in the near term. And the other really interesting point there was that its full year 25 target was below consensus. James Hardie there, it dived even as it posted a 1% lift in first quarter adjusted earnings, but it also warned of a challenging second quarter. Temple & Webster, wow, it had a great day, its best day in 2 years. Very positive results showing that despite all the cost of living pressures, we're still buying new stuff. And online recruitment platform Seek, one of the biggest laggards after lower job ads hit its bottom line, but also, of course, it was about the forecast here and the lower dividend. And wealth giant Challenger up 6.4%. It saw net profit jump 17% in the financial year. Let's get across all the numbers and what we saw in the market with Martin Crabb from Shaw and Partners. So yeah, just struggling for direction, you would say. What do you used to say about the ducks? Maybe the ducks are just swimming nicely today.
Yeah, lots of paddling below the surface. And I suppose some of those price moves, Juliet, are quite substantial. I mean, 7% for Seek and 6% for CSL, or 5% for CSL. They're big moves and big stocks. But it was enough positives to offset the negatives. So on the surface, as you said, the swan elegantly swimming across the lake, but beneath the surface there's lots of thrashing around. Yeah,
lots of little legs trying to catch up. Okay, well, let's dig into some of these results. I mean, it's all about the forward guidance, isn't it? And that's why companies are either being punished or, I guess, rewarded. CSL very much under pressure today. Yeah,
well, they what everyone was looking for was the gross margin for the Behring business. So there's three parts to CSL. Behring is the blood collection, fractionation, plasma business. Then you've got Vifor and Seqirus, which are their sort of biotechy kind of businesses. And so Bearings, their margins were expected to improve by 100 basis points. That's what they guided. And if you strip the currency out, they did that, but including the currency, they were only up 50. So the market got a little bit worried that, maybe these margins are not recovering. They took a big hit a couple of years ago on higher costs, and they're supposed to be coming back. But I think the fact that the company, we're just so used to this business growing at 20% per annum, we kind of expect that going forward. And they guided profits to plus 10 to 13%, and it just underwhelmed the market a little bit. So they didn't quite get to where we wanted them to get to on the margin. And then the outlook statement was for slightly slower growth. This stock has recovered pretty well and run into the result. I think people are looking for a good result.
Yeah, it's a pretty pricey stock, isn't it?
Yeah, so it's on a growth PE, and if you're growing at 20, that's fine. But if you're growing at 10 to 12, there's a lot of stocks out there expected to grow 10 to 12 that aren't on these sort of PE ratios. So not surprising to see a little bit of profit taking in that one. It had run pretty hard into the result.
Okay, we also heard from Challenger. I mean, that was very kind of impressive.
Yeah.
But you were telling me earlier it's not a stock that's that heavily owned.
Yeah, I mean, it's not a market darling or a retail favourite like, say, the banks or CSL, these sorts of things. I mean, the company has been around for a while, but I think it's had a pretty checkered history and it's had very volatile earnings historically. Very difficult to predict its earnings because of the nature of its business. It's selling long-dated annuities and then having short-term investment outcomes. So I think they took a little bit of a hit on their property book this time around. But net, I think people were quite happy with the cost control within the business. They actually guided their cost of doing business 200 to 400 basis points below where the street is. Some people are going, well, that's probably a significant upgrade to earnings. That's a 5 to 10% upgrade to earnings. If they can continue to run the cost structure down, the annuity business, the outlook for that's quite strong because there's only one or two players really in that annuity business, and everyone's saying as more money's coming out of super, more of it's going into pensions and annuities. So I think the longer term outlook for Challenge is quite good. If they can do that on a lower cost structure, I'm not surprised with that share price move today.
Let's talk about Seek because they blamed softer economic conditions and a slower hiring process, their first annual loss since COVID-19, and this came out trying to draw a bow here ahead of the jobs data with the wage price index too.
Yeah. Seek's an interesting one. Volumes are dropping like a stone, and that's partially because the labour market's softening up. So we're just seeing job ads, not just their job ads, but ANZ's job ads, etc., all coming off. So what Seek's trying to do is put the prices up to offset that. Now, I've heard anecdotally from some recruiters that Seek's just becoming too expensive to use. There's a lot more competition. I mean, LinkedIn is LinkedIn, eFinancial Careers, Indeed. There's a whole bunch of players out there and that are seemingly more affordable than Seek. I mean, Seek's been the go-to, particularly for blue-collar workers, for a long period of time. So I think the company's trying really, really hard to keep its price growth to offset the volume growth. But they also, I think they guided down volumes going forward as well. So a little bit like the Reserve Bank is out there trying to slow the economy down, trying to get the labour market to loosen up further, trying to get the unemployment rate up. That's not good news if you're in the recruitment business. So I think Seek's looking into a little bit of a headwind when it comes to volumes, and talk about nosebleed PE. I think the thing's on 70 times earnings. I mean, obviously earnings are deflated because of what's happening at the moment, but that's a pretty big PE number. So again, people are looking at these high PE growth stocks. You got car sales, REA, Seek, the old rivers of gold, Fairfax rivers of gold. At least the next 12 months is going to be a struggle for Seek. So I think that stock was off 7 or 8% today.
All right, and talking about the wages data, I mean, as expected, well, just a little bit lower for the quarter, I guess. But do you think, like Oxford Economics, the RBA would have breathed a sigh of relief at that? Yeah, look, it was one of the existential risks out there is that we have seen inflation numbers moderating, but we're just on tenterhooks for a bad number, and any bad number based on the what we've been hearing from Michelle Bullock and other members of the Reserve Bank is that they are itching to hike rates, and so any excuse you give them. I mean, 4% wages growth doesn't sound too bad if your inflation is 2 to 3% targeting, if you've got productivity growth. But there's a zero in Australia. There's plenty overseas, but the official statistics on labour productivity in Australia is zero. So if you're a business, you're not getting any productivity out of your workers. You've got to pay them 4% more. You've got to put your prices up. So these are still significantly high numbers. Yes, they're coming down.
So they're at least headed in the right direction, but they're still too high. And I think that's what the Reserve Bank's been banging on about, is these numbers, they're coming down that scrape, but they're still too high. We haven't done enough. And if there's no productivity growth in the economy, then these wage rises are inflationary.
Yeah. All right. Well, all of that, of course, in terms of what the RBA may or may not do. What do you think the RBNZ might do?
Yeah, I mean, I think their economy is showing signs of slowing quite dramatically. The labour market seems to be cracking. They don't have that house price pressure continuing that like Australia does. So I think, and their rates are a bit higher than everyone else as well. So I think the RBNZ, continues to cut rates.
And of course, we're looking ahead to inflation in the US too. Pretty busy week, actually. We've got to get amongst all these earnings as well.
Yeah. We've got the macro. So is it the macro that's driving the markets or the results? I think, results. I think CommBank tomorrow is a massive one. It's the biggest stock in the index. It's almost 10% of the index now. If they print a strong number, the whole market's going to rally on the back of that. The stock's, been one of the better performers so far. We think it's ridiculously overpriced.
What's a 137 last week?
Yeah, it's crazy. Yeah. It's 25 times earnings. It's nuts. But anyway, that's the market. The market's never wrong, right?
Until we have a day like last Monday.
Until it is.
And speaking of last Monday, I'd noted that the Nikkei, I think it's up something like 3% today, and it's now reversed all of the losses that happened on that horrid day.
Yeah.
How did you kind of view that? Was that just, it's not even really a correction considering it's bounced back.
No, it is. But Juliet, these are abnormal movements, and they're warning signs, whether it's a 60-point move in the VIX, which has only ever happened 3 times in history, or a 12% move followed by a 10% bounce in the Nikkei. These are not normal things, and they're just telling you that markets are skittish.
Yeah.
Yes, volumes are low. Yes, it's summer in Europe, et cetera, but yes, the Olympics are on. There's all these excuses as to why markets are volatile, but they're just warning signs for me. And with valuations where they are, particularly in the US, it's like it's a setup for more volatility going forward. So our advice to clients is just be a little bit cautious. Don't take too many aggressive positions because the market is susceptible to greater volatility.
And maybe buy a yen now if you're going to Japan.
Yeah, or lock it in already. Lock it in.
All right, Martin, always a pleasure. Thank you so much.
Thanks, Julia.
Martin Crabb from Shaw and Partners. Well, of course, the stock of the day was one of those that we followed very closely. It was CSL. Rudy Philippek Van Dyke from FN Arena and Ben Richards from Seneca Financial Solution joined Koshi.
Companies like CSL, when they go down on results, more often than not, that's actually not to be quiet upon because you own the shares. It's more of an opportunity to get on board, I think.
Okay.
And that doesn't only go for CSL, but it goes for a lot of the other quality companies we have as well. I think the main thing is they're growing still in double digits. They will do double digits for years to come.
I think although it's down a few percent today on a 3 to 4% miss on the FY25 outlook for net profit. Look, I think that's pretty harsh as well. If you take a long-term view, as Rudy said, then on 28 times PE today, we think it's a buy. We own it. It's probably a bit more underweight relative to the index, but I think it's a really strong growth company that, in a negative healthcare market sentiment, can be an opportunity.
All right, well, where were the opportunities today on a flat day? Let's have a look at the market leaders. Aurora up by 19.5%. Sims Metal, Genesis Minerals, Ramelius really just on the back of that gold movement, and Challenger, as I was mentioning, with Martin, one of the standouts of reporting season today, up 6.4%. To the downside, though, I would be surprised if, I'm being surprised because I thought SEEK would be on there, CSL would be on there. SEEK, though, is down 7.4%. Net Wealth, we had an interesting conversation with their CEO you can find on ausbiz.com.au. Audinate, one of the big movers of last week, down almost 5%. Nanosonics and Liontown Resources losers as well. In terms of the small end of town, you can see some of the gainers on your screen. They're led by Amero International, and in the lagging side of the small end of town, Latin Resources down by about 12%. Seven West Media, interestingly as well, down 10.3%. Seven Group Holdings out with its numbers tomorrow, along with Seven West Media. All right, tonight, the German ZEW Economic Sentiment Index, always a really interesting one in terms of how Europe is faring in the overall global economy. Also PPI out of the US ahead of the CPI data, and the FOMC member Raphael Bostic giving a speech as well. Tomorrow, we've got the RBNZ in our region, the cash rate there, no real economic data locally, but a big day of earnings. Now, we are going to be speaking to the CEOs of CBA, of AGL, also of Dexus, also of Homeco Daily Needs, also of Pro Medicus, and also of Seven Group Holdings. So you know where you've got to come to get all the information straight from the CEO mouths. We're going to have a very, very busy day with all of those earnings and CEO interviews tomorrow. Just checking where the market has finished the day's trade today. Up by 1/10% on the CBO 200, so a little bit better than what we saw on the open. Similar moves on the ASX 200, again of 1/10%, 7,825 points is where we are at. So, as mentioned, very, very busy day on reporting season tomorrow. CBA, of course, the biggest stock on the market, one of the biggest employers in the country. Many of us bank with CBA, of course, very, very big one. And as Martin Crabb said, if it does well, it's going to blow up, his words, and he means rise, lift the overall market. And David Koch will be speaking to CEO Matt Comyn. Be sure to catch that on our streaming and, of course, live tomorrow. But we'll catch you from 9:45 a.m. Eastern.